Welcome back to another explainer. Today, we are diving into one of the absolute most fascinating paradoxes of modern finance. Just picture the global market for a second. You've got millions of participants, trillions of dollars, and they are all staring at the exact same public data. Glowing screens, live news feeds, economic reports. It's basically a perfectly level playing field of information. Yet somehow, some people win big and some lose entirely. So how on earth is opportunity born from total disagreement? Well, let's find out.
Right, let's dive into this question because honestly, it is the fundamental mystery of trading and investing. If every single piece of major information, we're talking Federal Reserve reports, breaking news, the latest inflation data, is instantly available to literally everyone, why haven't all the opportunities just dried up? Think about it. If the market was this perfectly efficient machine where everyone reads the same data in the exact same way, the moment a news piece dropped, the price would just instantly adjust. No one would trade. There would be no buyers left and absolutely no sellers. But as we all know, the reality is completely the opposite.
Well, it really comes down to this core concept. Our trading methods, our algorithms, our technical tools, they are not magic crystal balls. They're basically just observation lenses. They bend the light to show us completely different facets of the exact same reality. So whether you're using price action, Elliott wave theory, or supply and demand zones, the underlying data hasn't changed at all. But the specific tool you decide to use, it gives you a completely unique perspective.
Section 1. Same data, different views.
Let's say inflation drops. Boom. The news hits the wire. Now, trader A sees this as cheap money coming, expects the Fed to cut interest rates, and just aggressively buys. But at the exact same millisecond, trader B sees that exact same drop in inflation as a huge warning sign of a weakening consumer economy, expects corporate earnings to plummet, and aggressively sells. It's the exact same data point, right? But it triggers two completely opposite, totally logical actions. This leads us to a really crucial quote. Information rarely has absolute meaning. Most prices are decided by how humans interpret that information. Raw numbers, they're practically meaningless in a vacuum. The actual market is not driven by the data point itself. It is driven purely by the narrative that we humans assign to those numbers. Prices move because of interpretation, not just information. Every single day, millions of times a day, this exact clash of interpretations is what creates all the volume and volatility we see.
Moving on to section 2. Different games, different goals. You can kind of think of the market like a bunch of converging highways. You've got a massive pension fund buying an asset to hold for the next 10 years, acting right alongside an intraday short seller who's betting on a quick 3-hour drop for that exact same stock. Meanwhile, a global exporter is out there buying dollars just to hedge real-world business risks, while a speculator sells them based on some macro trend. The crazy thing is, everyone is acting completely rationally based on their own specific goals, and that is exactly why there is always a buyer for every seller.
And you know, time is really the hidden differentiator here. Think about this. You pull up a chart for a single asset, let's say Bitcoin or the S&P 500. A 5-minute trader looks at it and sees a vicious, well, actually, they probably see a chaotic, fast-moving downtrend. A 1-hour trader looks at it and sees a totally steady, reliable uptrend. And a long-term investor, they glance at the exact same asset and just see a tiny, insignificant blip, a minor correction in a decade-long bull market. Let's just sit with that for a second. 3 participants looking at the same asset at the exact same second, making totally different decisions. And honestly, all 3 could be absolutely right within their own timeframes. The market doesn't have a universal clock. We're all playing at a different speed. Section 3. The human element. You know that classic optical illusion, the drawing where it looks like a duck from one angle and a rabbit from another? That is the perfect metaphor for market psychology. Even if 2 people read the exact same financial bulletin and they logically agree on all the math, their differing emotional states are going to trigger completely different physical clicks on the keyboard. Because we are dealing with the psychology of the chart. Fear, greed, FOMO, panic, overconfidence. A flashing red screen triggers paralyzing fear. A massive green spike fuels sheer greed. Then there's the desperate itch of FOMO, the blind panic of a sudden crash, and of course the incredibly dangerous blind spot of overconfidence. This is just human emotion constantly overriding rational data. It's the ultimate wild card that prevents markets from being perfectly efficient machines. Psychology is the market's true DNA. Which brings us to section 4, trading expectations. Now get ready because here is the ultimate aha moment. The market does not trade on current reality. It trades on the delta between expectations and reality. Good news absolutely doesn't mean the price just goes up. If the market expects record-breaking earnings and a company releases just good earnings, the stock crashes. Good news literally causes a drop because it just wasn't great enough. Conversely, if everyone expects a total bankruptcy and the company is just losing money slightly slower than before, the stock violently rallies. The market is never trading the present. It is constantly trading that gap, the delta between expectations and reality.
And finally, section 5, the nature of opportunity.
A lot of people out there believe that to succeed, you need some kind of secret, an insider tip, hidden data, something no one else has. But in our hyper-connected world, that is a complete myth. Like the quote says, it is a competition of who interprets data better, manages risk better, and acts with more discipline. Millions of people looking at the exact same chart create millions of different interpretations. And that resulting friction, that is exactly what creates endless opportunities day after day. Your true edge isn't some secret data point. It's you. So what lens are you looking at the market through? And are you actually playing your own game? Since the data is exactly the same for everyone, are you getting distracted trying to find the perfect indicator, or are you putting the work in to master your own psychological biases? Are you blindly following someone else's time frame, or are you playing your own game? Stop looking for the secret data and start sharpening your own lens. Thanks so much for joining me on this explainer. Keep learning, keep focusing, and I'll catch you in the next one.